Colleagues, friends, ladies and gentlemen, it's a real pleasure to welcome all of you to this Per Jacobsson lecture sponsored by the Per Jacobsson Foundation. As you may know, the foundation was established in 1963 and has been closely associated with the BIS over the years. The foundation was established to improve international cooperation in the monetary and economic fields. These goals are closely aligned with those of the BIS. And it's a real pleasure to me today to welcome Ben Bernanke, who kindly accepted to deliver this year's lecture. Ben started coming to the BIS since December 2002 and always made excellent contributions to the economic meeting discussions. You all know Ben, so there is not much that I can add. He will enlighten us on the real effect of disrupted credit, evidence from the global financial crisis. So we are delighted to hear about your insights, Ben, on this matter. We will have a panel of governors immediately after the lecture, and afterwards there will be a Q&A session. At that time, you can put your questions or comments to Ben and the panel. You will note we are recording the proceedings this afternoon. The videos of the lecture, panel, and Q&A session will be put on the BIS public website. So let me, without further ado, let me give the floor to Guillermo Ortiz, also very good friend of this institution, with a very long history here. He was chairman of the board, and now he's the chairman of the, already for quite some years, chairman of the Per Jacobsson Foundation. So, Guillermo, the floor is yours.
Thank you, Agustin. Good afternoon to everyone. It's my pleasure to welcome you at this year's edition of the Per Jacobsson Lecture on the occasion of the 88th BIS Annual General Meeting. I want to acknowledge the presence of Kate Langdon, who is the Vice President and Secretary of the Foundation, and also the Deputy Director of the Communications Department of the IMF. Ben, thanks for accompanying us. I'm going to, just mention that, his lecture is kind of different from the ones that we have had before here at Per Jacobsson Foundation, in the sense that it's not strictly about monetary policy. Most of the lectures that we have heard are about that subject. But it's been 10 years since the burst of the great financial crisis, and undoubtedly financial variables and the interaction with economic activity played a fundamental role in causing one of the major recessions in modern history. The financial sector played a major role amplifying the severity of the crisis by transmitting US economic and financial disruptions globally. With a lecture entitled Real Effects of Disrupted Credit, Evidence from the Global Financial Crisis, Ben will address the question of how financial crises affect credit flows, and more importantly, real economic activity. Let me give you a very quick glance at Ben's trajectory. As Agustin said, he held different positions at the Federal Reserve System. Last role was chairman from 2006 to January 2014. During his tenure, he oversaw obviously the Federal Reserve's response to the financial crisis. He also serves as the chairman of the Open Market Committee. If I read, the rest of his curriculum, I will spend a lot of minutes, so I'll just summarize it by saying that Ben was professor of economics and public affairs at Princeton from 85 to 2002. He had several endowed chairs. He was 1926 professor of economics and public affairs at Princeton, Howard Harrison and Gabriel Snyder back professor of economics and public affairs, and also chair of the economic department. Before arriving to Princeton, he was an associate professor of economics and an assistant professor of economics at the School of Business at Stanford, and his teaching career includes other universities. He's had a Guggenheim Fellowship and a Sloan Fellowship. He served as, he's a fellow of the Econometric Society and the American Academy of Arts and Sciences. He was appointed editor of the American Economic Review in 2001, and so many other things that I will stop right now and let him begin. Thank you very much.
Thank you. Thank you, Guillermo. Thank you, Agustin. It's great to be back in Basel, and thank you for coming. I'm honored to be able to give the Per Jacobsson lecture. This is my title, The Real Effects of Disrupted Credit. We spend a lot of time thinking about how to prevent financial crises, how to respond to financial crises. We take politically unpopular steps to do that. Presumably the reason that we do this is because we believe that financial crises have very adverse effects on the real economy. So there's not much doubt about that in general, but it's important that we understand better what the channels are, what the connections are, to help us think about future policy and help us to think about macroeconomic modeling and analysis in the future as well. So that's what my talk is about. Now, there's been a great deal of research on this general topic since the crisis, motivated by the crisis. So what I want to do in the 30 minutes or so that I have is two things. First, I want to talk about, give a very quick overview of some of the research and the developments since the crisis in economic research on this topic. And then in the second part of my remarks, I want to give you some new evidence that I've put together in the US context about how the crisis affected the US economy. So my starting point is traditional models of credit extension that focus on asymmetric information between borrowers and lenders. The idea that lenders have less information about borrowers than borrowers do themselves, information about their quality, their characteristics, their projects, their effort, and so on, and that this asymmetric information creates various kinds of costs, principal agent problems, costs of screening and monitoring, adverse selection. Those costs, in turn, are reflected in what's called the external finance premium, the idea that there's a deadweight loss or an additional cost of a borrower getting credit from external sources. Now, the external finance premium, called the EFP, can be important in macroeconomics because it's possible that as the EFP varies over time, that it can help to explain business cycles and fluctuations in the economy. Importantly, the sharp movements in the EFP during a financial crisis can help explain why financial crises are so deadly and so dangerous to an overall economy. So the EFP and the idea of the costs of borrowing externally is going to be central to my analysis. Now, the EFP, in turn, depends on a variety of things, but among them are the financial health, broadly defined, of both potential borrowers and potential lenders. On the borrower's side, asymmetric information problems are less when the borrower has, quote, skin in the game, when the borrower has lots of his own net worth, has collateral. A strong borrower balance sheet makes it safer, cheaper, easier to lend to that borrower and reduces the external finance premium. So this implies that descriptors of the financial health of borrowers, like collateral or net worth, can be a state variable that helps explain the evolution of the economy. So the idea of the financial accelerator, which is a term that I coined with co-authors many years ago, the idea is that when the economy turns down, borrower balance sheets worsen endogenously, and that in turn makes borrowing more costly and reduces credit extension and accelerates the downturn. On the lender side, banks are also borrowers, of course. They have to get funds in order to make loans, and they specialize in making those loans. And so in the similar spirit, cyclical movements in the balance sheets of lenders, banks we'll call them, can also exacerbate real economic downturns. So in particular, if there's a loss of bank capital because of a downturn, that makes banks, makes it more costly for them to get funding, and that in turn makes lending more costly. Likewise, if liquid assets are complementary to lending, then greater difficulty in getting funding or higher costs of funding can also reduce the ability of banks to make loans, raise the external finance premium, and hurt the economy. This is what the idea of the bank lending channel of monetary policy in this paper that I cite here is an example of recent work on the so-called bank lending channel. Now, an extreme example, and one I'm going to focus on today, is a panic. Now, for a variety of reasons, as we know, many intermediaries, banks, fund themselves with what Gorton and Bernanke called informationally insensitive liabilities. Think of a demand deposit, think of the senior tranche of a securitization. These are assets that are extremely safe, are viewed as being basically 100% guaranteed, and therefore investors don't have to spend a lot of time evaluating and analyzing the quality of those assets. They can simply use them, and they're very liquid, they're easy to buy and sell, and that's the advantage of funding through those types of mechanisms. However, as you know, there can come a critical point where suddenly people lose confidence in these informationally insensitive liabilities, become informationally sensitive, as in a bank run or in, as we'll be talking about, when people lost confidence even in the senior tranches of securitizations. When you lose confidence in these liabilities, you get what's called a panic. Funding flows out of intermediaries, you get a major disintermediation, and so suddenly non-banks, people who are not specialists in making loans, have to hold existing loans and have to make new loans if they're going to be made. The external finance premium shoots up, and that has presumably very significant consequences for the economy. So that's all by way of basic theory. Now, unfortunately, before the crisis, these sorts of ideas, although they were certainly present in macroeconomics, were not part of mainstream macro models. And I want to illustrate this without picking on the Federal Reserve, but I want to illustrate this by looking at the forecasts of the Federal Reserve staff for unemployment during the period of the financial crisis. So the red line here, if I can make there we go. The red line is the actual unemployment rate in the US over that period. And the blue lines are forecasts of unemployment made by the Federal Reserve staff at different dates. So in particular, here is August 2008. This is already 8 months into the recession. The staff was seeing the maximum unemployment rate at 6%. And indeed, in August 2008, the staff were asked to do an analysis of an alternative scenario, which was called extreme financial stress. So they were supposed to assume the financial system was going to come under much, much more pressure than it already was on August 2008. And their models came up with the conclusion that the maximum unemployment rate would be under 7%. In October of 2008, after Lehman, when the financial system was already seizing up, the maximum unemployment rate forecast by the Green Book was about 7.5%. And of course, the actual maximum was close to 10. Now again, I don't want to pick on the Federal Reserve, and I was there too, so I'm part of this forecast. But the point is that the models were not prepared to anticipate and understand how serious the credit disruptions were going to be and how bad they were going to be for the real side of the economy. Now, why were credit frictions neglected in macroeconomics before the crisis? Well, a variety of reasons. Parsimony didn't seem necessary, computational barriers. But one reason I want to stress is the endogeneity of state variables. So a lot of pre-crisis tests of these theories looked at things like the forecasting value of output by credit, or the links between cash flow and investment, those things. The problem is that all these variables are endogenous. And so you can think about credit as forecasting output for credit friction reasons, but it could also be endogenously responding to other factors that are moving output around. So that endogeneity made it difficult to identify these relationships. Now, of course, attitudes are changing. We know the Great Recession was certainly an object lesson in the impact of credit frictions on the economy. And moreover, it raises the possibility that if credit market stress was so important for the Great Recession, maybe it should be in regular macroeconomics, so to speak, as well, in garden variety business cycles. And importantly, although of course this was a side effect, The fact of the crisis helped solve this identification problem, because now if you looked at how a given set of firms or households responded to the crisis, you could treat the crisis from their perspective as largely exogenous. And then you could look cross-sectionally and see which firms were most hurt, which firms responded the most, which households responded the most. And that gives you a much better identified test of the relationships of these credit theories. So I'm going to talk a little bit about some of the recent papers, many of which have used this sort of natural experiment design to identify the effects of credit disruptions. I have a much more detailed presentation, which I'm happy to share with anyone who would like to see it, with the bibliography. So this is just hitting a few highlights of the recent work. So the crisis as a natural experiment. In some of the papers, on the borrower's side, here's just a few of the recent studies. Mian and Sufi, many of you know, have done interesting work on household balance sheets and how that propagated the Great Recession. So they looked, for example, at counties or zip codes where leverage had built up more before the crisis, and found that those counties and zip codes reduced their purchases of consumer durables by more when the shock hit, for example. A nice paper by Baker in the Journal of Political Economy looks at millions of individual households and uses some very interesting identifications to show that households that are more leveraged, more indebted, holding constant their wealth and income, are more responsive to income changes than other households. There's a great deal of work on non-financial firms. And again, the idea is to say, let's look at a whole range of non-financial firms, characterize their initial financial condition, and see how the financial crisis affected them, and therefore get something close to a controlled experiment. So the studies that have been done conclude that non-financial firms that had initially higher leverage happened to have long-term debt that was maturing during the time of the crisis, when it was obviously hard to refinance, that were in industries more dependent structurally on external finance, or were smaller firms, therefore harder to lend to. All of them reduced hiring and capital investment by more than other firms in response to the financial crisis. Likewise, there's a whole variety of tests on the lender side. For example, US banks that were more reliant on wholesale funding, which was obviously more sensitive to the crisis, or which had greater mortgage exposures before the crisis, reduced their lending by more to non-mortgage borrowers. So the fact that I had a lot of mortgages on my portfolio, I lost a lot of money, that made me less able to lend to non-financial firms, not mortgage lending, but non-mortgage lending. There's interesting studies which show that also in the non-bank lenders, so for example, in the United States, a lot of auto loans are made by leasing companies, which in turn depended on the asset-backed commercial paper market. Those leasing companies, which were hit by this ABCP collapse, the car sales in those areas where they were dominant fell a lot more than other places. So again, even non-bank intermediaries play a role. Here in Europe, most of this evidence is US-based, but there's a lot of evidence about the cross-border effect of banks. For example, just to give an illustrative example, German savings banks whose parents were exposed to subprime mortgages and lost money in the US cut their lending to local German consumers by more than other banks. So there was this transmission across borders, which importantly has been shown not only to affect lending, but also to affect activity, so that some of these studies identify the borrowers, the firms that were linked to those banks, and show that those firms in turn cut their spending and employment by more than other firms. I want to just mention the Great Depression. This is how I got into this issue many, many years ago. In 1983, I wrote a paper arguing that essentially the disruption of credit flows, both because of bank panics and because of borrower insolvency, was a cause of the Great Depression. But the empirical work that I did relied on time series, aggregate time series for the United States, and some cross-sectional comparisons across countries. I just want to note, without going into it, that since the crisis last decade, a number of studies have actually been able to create panel data that is small firm and household level data from the 1930s and make similar analysis, which has tended to confirm, again, as in the 2008 crisis, that these credit flows were important for real activity. Now, so that's what I've just described is mostly microeconomics. What about macro models? So a paper that I wrote with Mark Gertler and Simon Gilchrist in 1999 was one example of a macro model that included these credit factors, a so-called financial accelerator model. But what it did was it showed that including credit market frictions improved the fit of the model, But credit market frictions were not the primary source of downturns in our model, nor were there large and discontinuous shocks in our model. It was mostly a continuous type of process. Now, new work, more recent work, has, I think, improved along various dimensions. First, credit market factors have been shown to be important or even dominant drivers of real fluctuations in macro models, and I give you Cristiano Eichenbaum and Trabant as an example. Mian and Sufi, who I mentioned before for their work on household balance sheets, have argued that expansions and contractions of household credit quality are a driving force of business cycles in general, not just in 2008, but at other times. And I think their basic viewpoint is very consistent with the story that Claudio Borio was giving this morning. Secondly, the new models show that financial shocks can have large nonlinear effects. My former co-author Mark Gertley and Nobuki Yataki have a very nice paper in the American Economic Review which incorporates banking panics into a macro model. And when there's a banking panic, because there's this very sharp disintermediation, external finance premium rises very quickly, you get very sharp reactions in the economy. Brunermeyer and Senecoff at Princeton also have a model like that. And finally, I just want to mention that reduced form models based on financial factors can also prove to be pretty predictive, and the Gilchrist and Zochterzet paper, also AER, where they calculate from corporate bond data, they calculate a measure of the external finance premium, find it's very predictive of real economic activity. Now, what I'd like to do now in the second part of my remarks is turn to some new evidence that I've put together, and this is a preparation for another paper coming up later this year, about the way in which the financial crisis affected the US economy. So my story is going to be based on a figure here, which I'm going to put up now, which is related to a paper by Gary Gorton and Andrew Metrick in 2012. And what this figure is going to show, basically just by looking at a couple of representative variables, is going to illustrate the stages of the financial crisis in the United States. So the first stage is shown by this variable. This black line, the variable is called the ABX. This is a measure of a derivative instrument which is based on the value of 2006 vintage subprime mortgages. So this line just shows you that in 2006 subprime mortgages were valued at 100. They were full value. But then you can see that over time, in mid-2007, this valuation began to drop. This is a market instrument. Fell again after BNP Paribas, and then, of course, fell very close to zero as time passed. So the collapse of the subprime mortgage market and the mortgage market more generally obviously is indicative of the effect of that on both household balance sheets and lender balance sheets, including banks, as I'll show. Now, add to this picture a second variable, this gray variable. This is, I'm illustrating it with the spread between LIBOR, 1-month LIBOR, and the OIS, which is a measure of expected Fed funds rate. And what this basically shows is a broad measure of funding stability. So when this measure goes up, it suggests that people are losing confidence in banks, asset-backed commercial paper and the like, and pulling back on their lending. Now, as Gorton and Metrick pointed out very interestingly, the initial decline in the value of subprime mortgages was not reflected in the LIBOR spread. Okay, so there was no immediate reaction, even as the value of subprime mortgages fell considerably over the early part of 2007. But when the BNP Paribas announcement came in August of 2007, suddenly there became new frictions in the LIBOR market, in the bank lending market, and of course after Lehman we had this enormous shock to spreads. It came back down, and I'll argue in part because of policy responses, but you can see it's a very distinct pattern from the mortgage pattern. The third variable, this variable is represented by the the asset-backed security spread for credit cards. So importantly, this is a spread for securitized credit of non-mortgages. This is not mortgages, this is non-mortgage credit. And you can see here that what Gorton and Metrick emphasize is that this spread began to widen, suggesting people were losing confidence in securitized credit. And then after Lehman, there was this huge run-up, which Gorton and Metrick call the run on repo. The people were no longer willing to finance securitized credit. And indeed, there was a fire sale. A lot of this was dumped on the market, drove down these prices, and that's what you can see in this picture here. The stress tests were important in bringing that back down. But this is a separate phenomenon, the run from securitized credit products, including, importantly, non-mortgage credit products. And then finally, this green line is the CDS spread for the Bank of America. It's just a measure of the solvency of the banking system. And you can see that all these pressures from falling mortgage prices, increased funding problems, the decline in the value of securitized credit, all of this led to a rising concern about the solvency of our U.S. banking system, which only came down after the stress tests and was moderated until later we hit the debt ceiling in the European crisis. So this is just these are just, as far as you know, these are just random variables I put up there, but they are interesting because they illustrate, I think, the main stages of the building crisis. And each of these stages, based on the theory I gave earlier, in principle, would be important for determining a real output and the effect of unemployment and investment. Okay. Now, an interesting point I wanted to make is that those variables that we were looking at were not purely correlated. They were obviously big discontinuities. So you had a big decline in mortgage values before there was any effect on funding. Funding went up, problems increased for a while before there was this big run on securitized credit. And so from an economic point of view, although obviously there's a causal sequence going through this whole process, there are these important sharp discontinuities and nonlinearities, and I'm going to rely on those for identifying the effects of these different parts of the crisis on the U.S. economy. So questions. First, are those patterns which I showed, individual variables, are they representative of broader data? And secondly, do the discontinuities in data in fact allow for identification of the effects of these stages of the crisis? So, for example, what were the direct effects of the mortgage losses, of the panic, or of the deteriorating balance sheets? And if that can be identified, what does this tell us about how to respond to this crisis and future ones? Now, my methodology is factor analysis, which you know is just a way of summarizing a large number of data series in a smaller number of series, which kind of capture the broad movement. So I'm going to look at 75 series. They're daily data. These are financial variables, so they're daily, okay, for the period 2006 and 2012. And I'm going to break them into 4 categories, and they correspond to the 4 variables I described before. First category is housing and mortgages, so the ABS spreads for home equity loans, home builder stock prices, et cetera. Second category is short-term funding, LIBOR, OIS spreads, TED spreads, spreads for asset-backed commercial paper, repo spreads, so those sorts of variables. The third group is non-mortgage, importantly, non-mortgage credit. So these are asset-backed security spreads for things like credit cards, auto loans, and student loans, and also corporate bond spreads. And then the fourth category is bank solvency, for which I'll use, for the largest U.S. commercial and investment banks, their CDS spreads and their stock prices. So here's 4 groups of variables, 75 financial variables in 4 categories. And I'm going to apply factor analysis to those 75 variables and try to reduce those variables to a smaller number of series. I'm going to do 2 basic exercises. The first one is I'm going to apply factor analysis to the full sample of all 75 variables without making any discrimination about which category variables are in, and just try to see what explains the basic patterns there. And what we find is that 3 factors appear essential. The 4th one is kind of borderline. I'm also going to do factor analysis separately to each of the 4 subgroups that I described. And so there's 1 factor explaining each subgroup. So this basically, just think of this as a simple summary variable for each of these categories of variables. Now, without going into technicalities, the interesting thing that's going to turn out is that these 2 different exercises give you exactly the same pictures. So let me show you that, and then I want to explain why and why it's interesting and why it's useful for us in thinking about the question we want to answer. So in this picture, the black line is the first factor. So if I just do a factor analysis on all 75 variables without any kind of discrimination among them, the first and most important factor, the single unobserved variable which explains the most variance across all these variables is this black line, which I'll just call factor 1. It's the number 1 factor. But look what happens when I compare it to the factor which comes only out of the housing subsample. It's the same thing. Okay, so in other words, the first factor explaining all these financial data was the housing information. The second factor, factor number 2, is shown in the black line. The gray line is the single factor drawn from the non-mortgage credit category. Fairly similar. Okay? And again, I'll explain why this is important, but I just want you to observe that you get the same result either way. This is the third factor. So at this point, we're already explaining most of the variation with the first two factors. We're now down to the third factor. That's the black line. The green line is the subgroup sample factor from just the funding, the LIBOR minus OIS type of variables. And again, very, very similar. Now, the fourth factor is not very important in explaining the aggregate. That's the black line. The red line is the sample, is the description of bank solvency. You see it's not as close. And if I just look over here, these are the correlations of the full sample factors, 1, 2, 3, and 4. So these are the factors explaining all 75 variables compared to the subsample factors, housing, funding, non-mortgage credit, and banks. You can see that factor 1 and housing are correlated 0.98. So that's here. Factor 3 and funding are correlated here. Factor 2 and credit are correlated there. But factor 1 is the dominant explanator of banks, which basically means that banks are being driven by mortgage quality. And so there's not separate information in what's happening to the banking system that's not captured somehow in mortgages. Okay, so this just shows the factors from the full sample, and all of this just wants to show you, this picture is basically the same picture I started with. It wants to show you that the 4 stages of the crisis that I described earlier do in fact describe the main stages of the crisis, even looking at a broad set of macro variables. Now, a word about why we got the same picture for the individual subcategories as we did for the whole category. We're using here, so when you do factor analysis, the factors you get are unique only up to an orthogonal rotation. So you can rotate them in various ways. And what your standard package will do is try to find a particular rotation which meets a certain criterion called the Varimax criterion. And what it basically does is it looks for groups of variables within your whole set which are within themselves closely correlated but aren't so correlated with everything else. So what this is basically telling us is that those 4 groups of variables that I described are, of course, closely correlated with each other, but across those 4 categories, they're actually only weakly correlated. And that's what the factor analysis is telling us. And so it's interesting because what it's basically saying is that the picture I started with really does describe the stages of the crisis, and we can view them as semi-independent stages that were not perfectly predictable from the earlier stages. Okay, so now, given those economic interpretations, we can now ask, how do they forecast the real economy? How are they linked to real economic developments? Now, one thing you can do is take the subgroup factors, orthogonalize them, and then use them as forecast. I do that in an addendum which is available on request. But what I'm going to do instead is I'm going to basically ask the question, how do those 4 factors, which describe the 4 stages of the crisis, how do they predict how the U.S. economy evolved? Now, one quick digression before getting to that. So we saw earlier that there was a big run-up in the spreads on asset-backed securities, on securitizations. And I interpreted that as Gorton and Metric did, as being a sort of a general loss of confidence in securitization assets in general. Now, a possible alternative would be that maybe this was reflecting some deterioration of balance sheets in the household and non-financial sectors. But if that were the case, then you would expect those things not to be so correlated. What I've done here is I just take the credit category, break it into the household and firm subcategories, and take a factor from each, and the fact you get exactly the same result shows you the same force is driving the abandonment of securitizations, both lends to firms and loans to households. So again, this is just a bit of evidence to suggest that credit factor we're talking about is really the run on repo, the run on securitizations that happened after Lehman. Okay, so what I'm going to do is aggregate these daily financial factors to monthly sums, and then I'm going to just see how well they forecast a variety of monthly macro indicators. The idea being that if an independent factor is a good forecaster, highly correlated with a macro indicator, then that's evidence that there was some causal relationship. Now here's the F statistics. So factor 1, again, is housing. Factor 2 is non-mortgage credit. Factor 3 is funding. Factor 4 is bank solvency. There's a list of macro variables down the left side. Notice that none of these were used in the construction of the factors. And you can see that the stars suggest statistical significance. You can see that the dominant predictors of macroeconomic outcomes are the credit and funding variables, the credit variable in particular. So it seems to have been the panic aspect rather than the housing per se, the mortgages problems per se, or the bank solvency problems per se that has the most predictive power. Now, in terms of getting a quantitative assessment of how important these were, we do simulations, dynamic simulations, where we ask the question for each factor, suppose all the other factors that were zero, how much of the individual variable does this factor explain? And I'm just going to show you two right here just for illustration. So the top variable is monthly GDP constructed by macro analyst. That's the black line. The colored lines are how much of this variable are explained by each of the individual factors by themselves. And the thing to note is that the green line, which is the funding factor, which reflects the initial run on commercial paper and on the banking system, leads the GDP number, but is only partially explanatory of how much GDP declined. The big factor, the really important factor, is the credit factor. So the run on securitization and the impact on asset-backed securities was the thing that's most correlated with GDP. Here's a very similar result for industrial production. Now, I think to get the results even sharper, I want to ask the following question. Let's think about factors 2 and 3, the funding factor and the run on securitization, as being both products of the general run, the panic that hit initially after BNP Paribas, exacerbated after Bear Stearns, was the sharpest after Lehman. Let's put those two things together and call them panic, factor 2 and factor 3. And then the other two factors, factor 1 and 4, mortgages and bank solvency, we'll call them non-panic, but they're just basically balance sheet factors. And let's look at the predictive power of those things. And you can see the overwhelming statistical evidence favors the panic factors relative to the non-panic factors. And I want to show you a few pictures. So here's, again, the black line is monthly GDP. This line here, gray line, is the non-panic factors. This is everything coming out of mortgages and banks. And the blue line is what I call the panic factors. This is the run on short-term funding and the run on securitizations. And notice the big difference. Industrial production. Actual industrial production is perfectly explained almost by the panic factors. Real PCE, real personal consumption. There is consumption, there's the panic factor prediction. Capital goods orders, again. Employment, even employment. There's black line is actual employment, the blue line shows the forecast of employment given the panic factors, and unemployment, where the panic factors actually lead the actual unemployment. Now, two more which are interesting. This is housing starts. So the black line is actual housing starts. So what we see here, and this gray line is the so-called non-panic factors. This is the mortgage and bank deterioration. Notice that from the beginning of 2006 until, I guess, early 2008, it's actually that first factor, the housing mortgage factor, which explains the decline in housing starts. But once we get into late 2008, 2009, that is dominated. Even housing starts are more affected by the securitization crisis than by the mortgage crisis. And finally, and this is, again, also important, remember I started off my talk by talking about the external finance premium. A measure of the external finance premium was this paper by Gilchrist and Zakerzek, where they used corporate bond data to calculate this excess bond premium, they call it. This is their estimated excess bond premium. This is the forecast of the bond premium tying to the panic factors. So this is very consistent with the general view that the panic created a sharp increase in external finance costs, created a big decline in credit and credit availability, and that was the main factor driving the decline in the economy. So again, I want to say that I'm not saying that mortgages weren't important, for example. They obviously were. They were part of the driving forces that made securitizations less attractive. But what I am saying is that because of the discontinuities, we can easily say that without the panic, without the transmission of the mortgage problems into a much broader financial panic, we would not have seen the same kinds of economic effects. Now, I won't talk about policy, but this is daily. These factors are calculated daily, so you actually can look day to day and see what factors are affecting them. And so here is just to show you some things I can look at. here at the bottom, for example, this is the funding factor. These are the whole variety of short-term funding programs that were put in place, which ultimately led to the reduction in the funding issues. But those programs, like the TARP and the CPP and CPFF, et cetera, did not solve the securitization problem. It took MBS purchases, stress tests, and QE1 to begin the process of solving the securitization crisis. All right, so I'm going to conclude. I hope I haven't gone too far over. There's been a lot of new research now on the effect of credit market disruptions, and the fact that the crisis generated effectively a natural experiment has been very helpful. The research strongly supports the view that variations in credit market conditions and changes in the external finance premium matter for credit flows and real activity. This is something that should be more incorporated into macro modeling, forecasting, and analysis. And finally, evidence from factor analysis shows that the financial panic of 2007-09, particularly including the runs on wholesale funding and the retreat from securitized credit, had the most powerful effects on the economy. So there have been some, I think, revisionist views that maybe policy should have focused on foreclosures, for example, of mortgages, and let the panic run out. I think what this suggests is that the panic was, in fact, the most dangerous part of the crisis. So future work needs to take into account how severe the costs are of financial instability, particularly panics that lead to massive disintermediation. Thank you.